All right, team. So I am freshly back from jiu-jitsu today. We have a Jerome Powell speech. Really, what it is it's a panel by the IMF starting pretty soon. The market is mostly flat. We had a little bit of a dip earlier at 1. I'm not sure why. Let's see if we can figure it out. Amazon is exploring potential bid for Premier League television. Fed Barkin says there are a wide range of possible outcomes for the economy. Bostic says policy stance is likely sufficiently restrictive. Barkin says we are still not seeing the full effects of rate hikes. Base rate expected to be held at 5.25 through the Q2 of 2024, according to a October poll. It matches with that as well. Bill Holding said it's not preferring it. Looks like Barkin is the one that's influencing the market. Fed's non-voter. All right, guys. So yeah, we got Powell today. So I'm looking at Nvidia. Nvidia's kind of flat today as well. You can see the SPY is slightly down. It's at 436s. 437 is the previous close. So like we have a small red day. The bond auction. Yeah, oh yeah, that was today. All right, we still got 40 minutes until the IMF speech by Powell. We're gonna get a poll going live. Again, it's about 39 minutes left. We're starting up a little bit late, but you guys will have to understand. There we go. And again, Nvidia really green on the day, flying up, which is surprising how the market's even red today. Oh, guys, I'm fresh back from jiu-jitsu. It was a good class too, but man, I'm burnt right now. Yeah, the 30-year bond auction came in at 4.769%. Again, Powell speaking in 39 minutes. We got the Fed's balance sheet dropping at 2:30 as well. But let's get some music going here. And again, Powell is going to speak on an IMF panel, International Monetary Fund. He's going to be speaking as a panelist again. Again, IMF is the International Monetary Fund. In its entirety. Subscribe for more free economy trading content. I'm not saying I'm tired, but I'm definitely freaking tired, guys. All right, so let's get some music playing here. My bad, team. Again, the SPY back up a little bit after the bond auction. Again, 4.7. You know, if this music is too loud. Let me know if you can even hear the music. Yeah, we have Barkin speaking again. Let me check the crypto crash. Did it really? If it did, I'm assuming it's because the spot ETF didn't get approved. Oh, it did. It dropped all the way back down to 36K, 36.5K. Disney's still looking lovely right now. I maybe should have held, but sweet tea from Canes. Disney, all the way up to 91s almost here. Home Depot, like retail is taking the biggest hit today. AMC as well after their offering. SPY drops nearly $1 and people call it a crash. Yeah, I mean, they're just trying to confirm their own bias is usually what it is. What was a crash? I mean, I don't know what, it depends on what you consider a crash. Percentage wise, again, if we're looking at like percentages here, okay. Going from Bitcoin going from 38.4K to 36.7K is a drop of 4.4%. So not really a crash, kind of maybe a correction. It's been up a lot. I'm not sure why. But again, SPY is pretty flat. I mean, this is a big drop, but it's just from news coming out. I wouldn't say it crashed. Hey, thank you, Kay. My guy, thank you, man. Powell gonna pump this dip. We'll see. Is the speech public? I mean, can we see it? I think so. I'm pretty sure you can. I'm not 100%, I guess. Let me check. Yes. Yeah, conference is open. We can watch it. Yeah, so Powell's going to be a panelist. I'm assuming we can watch it, right? Let me check with Pawn real quick. I'm going to check this out for me. Again, Nvidia back up to almost 480s. Oh, is my mic the wrong mic? My bad, guys. Hold on, let me fix this. Okay, yeah. So again, it's going to start at 1 p.m. where Powell is a panelist. Okay, so we got it. We're going to watch it for sure. All right, let's do a poll. I'm not muted. Y'all can hear me, correct? What's up, Snow? Yeah, we had to fix our mic, brother. Yeah, it's 1 p.m. my time, though. So, like, I'm just talking about my time. It's at 2 p.m. Eastern Standard Time. Yeah, we're ready. Sweet Tea from Cane's is so good. All right, we're going to do a poll here, as we always do. Today's Powell interview and panel calls a bullish or bearish market response.
All right, vote on that poll right now. That poll is now live. Yeah, it's in 32 minutes. There might be a timer up on the top left of the channel. Tesla dipped. Yeah. Oh, can y'all not hear the music? Sorry, if I'm looking kind of rough, I literally just came straight from jiu-jitsu. I wasn't even able to shower. All right, so yeah, this is the IMF. IMF is a global organization that works to achieve sustainable growth and prosperity for all 190 member countries. Can y'all hear the music? Let me know. Can you? You should be able to. Oh, Cane's is super good. Great chicken. Great fried chicken. I don't know. I love Cane's, but I'll be honest. Every time I eat it, I feel sick and nauseous. It must be something they make it with. It also just might be the ketchup, like the acidity of the ketchup. Okay, good. Hey, what's up, Laugh? Okay, good. Make sure y'all can hear the music. I'll follow some super nerds blockchain. The only reason I know where the market is going until we get up to a trace limit. Nobody knows after that. I need more I don't know on these polls. Cane's is good, right? I'm with fried chicken though. I'm really more of like, I like a bone in chicken. Like I don't really like boneless chicken or boneless strips. I don't know if it's just kind of like instinctually I like bones in my meat. But Cane's is good. The Texas toast is good too. You know, Cane's actually, believe it or not, is a Baton Rouge, Louisiana chicken place. Like it's from Baton Rouge, Louisiana, right? So that's where the founder was from. The founder went to LSU. I actually have seen his house. He's got like this big tree house in his backyard. I know somebody that lives by his by his house, and he's got this monstrous tree house in his backyard. It's really, really cool, to be honest. But yeah. Yeah, I believe coffee's definitely more acidic than tea, of course. It's good. It's for sure good. You got to get the sauce with it though, the cane sauce. All right, Tesla down a lot. Tesla dropping all the way back down to 208 today. Yeah, weak Treasury bond auction is what this is. So Live One cuts annual outlook. CEO cites Tesla deal extension and forecast record-breaking fiscal 2025. HSBC initiated coverage on Tesla stock with a reduced rating at $146 price target. All right, Team SPY at 436. Looking pretty weak. We get to look at like the NASDAQ here. Check out what it's doing a little bit more. Again, here's the Q. Q completely flat on the day. The SPY's a little bit more red. Again, Disney doing well. Nvidia doing well today. And we've got Powell again today, guys. Again. We've had Powell multiple days in a row. You love to see it. Then next week we got CPI. What's after, man? It's been a busy couple weeks, man. You know, tomorrow we got a little bit of a slow day. We got Michigan inflation expectations at like 10 that we'll cover. And then what do we got the following week? I think we got like, I haven't even looked into next week. I think we got Nvidia earnings. It's not this week. It's not next week, but the week after, I'm pretty sure. Crude oil inventories. Nothing Monday, the 13th, Tuesday. We got CPI next week, Wednesday. Oh yeah, Wednesday we got PPI, retail sales, New York State and manufacturing index. Thursday, jobless claims, Philly Fed index, industrial production. Friday, building permit data, housing starts. Man, what a busy 3 weeks. And then the next week after next week, Q now technically green, so tech is doing a little bit better. The week after next week, we got existing home sales, core durable good orders, Michigan inflation expectation, consumer sentiment. Manufacturing and services PMI. All right. I went in third. Good RX. You betting a Sandal rally? I don't know. I hope so. There's no way we're just going to just get cheap prices, then back up again. Careful with your leverage, everyone. I mean, there's definitely a way, you know. Again, somebody said the quote this morning, the market can stay irrational longer than you can stay solvent, sir. And yeah, the 30-year auction is definitely what tanked the market. Being overbought and it's bouncing off a daily resistance. Jay, please save us. We'll see. S&P closes green and it will be a historic rally. We're not that far away. I mean, it's certainly possible that we can have a rally today. 437s is the previous close. That's less than $1 on the SPY away, right? So that's, you know, not very much at all. You know, $4 on the SPY is about 4%, right? So that's 0.25%. A little bit less than that, actually. But, you know, the SPY is just now ending this latest crazy historic run. 1, 2, 3, 4, 5, 6, 7. We had 7 green days in a row on the SPY. The Q still in its run. Q still technically green today, although yesterday we did have finally a red day after 1, 2, 3, 4, 5, 6, 7. 7 red days or 7 green days in a row here, which is, again, historic for sure. Tesla announced a layoff. Yeah, layoffs have actually been affecting the stocks better because of inflation fears. There's also some stuff going on overseas regarding the conflict. All right, guys, Disney at almost 91. All right, guys. So again, look at the Q back. Let's see if the SPY can make it. We still got over 20 minutes until Big Powell. Pretty flat couple days, though. Tesla really kind of wearing on the market. Tesla down to 210s. Tesla was almost up to 230s. So it's a pretty big drop. Again, Disney with a huge run back, which is kind of crazy as a run. Again, slap that like button. We got 31 likes, and we got 300 plus people here. When Powell speaks, we'll have over 1,000. And so again, hit the like button. Support it now before everybody gets here so you're cooler than everybody else's team. You know you want to. Oh, dude, I literally came straight from jiu-jitsu. Like, literally rolled, had 2 really hard rolls. I've been fishing for arm bars a lot more. You know, originally I was just kind of like a guillotine dude, and now I've been fishing for arm bars a lot more. Had 2 really good rolls, and then literally hopped in the car, drove here, got home, walked into my office, and now I'm working again. That's all right, though. I always like Powell days. Here's the SPY. Powell days get fun. The stream gets crazy. Yesterday for Powell, we had over 6,000 people here live. We had like 6,700. Smashed the like too hard, broke my screen. Hey, that's the point, bro. Oh, my boy Powell crashed the market. We'll see. All right, guys. Let's see if we get something good today. I hope we do. Again, market's kind of flat anticipating Powell, I think. The market's scared of Powell, you know? And understandably so. I'm kind of scared of Powell, to be honest. This whole meeting's supposed to last for an hour and a half. Like an hour and a half is how long this meeting's supposed to be. I'm betting on Powell to help the market right now. Let's see if he does. All right, so market's very rangy here. Look at the SPY all the way at the bottom of this trend line. Just dump it down fast. Only Powell can save the day. We'll see if he does. Hey. All right, guys. Yeah, we're watching the S&P 500. The S&P 500 is trying to hold. You know, it did dip, bounce back. I look at it as pretty choppy ahead of Powell. I think the market's probably kind of flat right now. Hopefully Powell can say some good things and help the market rebound. Hopefully the market's resilient. He utters the words sufficiently restrictive. We're going up. Oh, I believe so too. There's not more area for the market to go up without a bounce. We would not be making much money. I hope Powell brings the market down just to cool off tech and start to put in higher, low. Do you trade or just commentary? Yeah, we trade. We do a little bit of everything, bro. Market's starting to dump. All right, so we get a SPY dipping down a little bit. Yeah, I mean, this TOS account's got like 50K in it, you know? So, I mean, we certainly trade. The market's starting to look weak, though. I mean, market's been on a pretty big run, though. You know what I mean? The last couple weeks. But again, Powell has the chance to protect us, to save the world, save the market. We'll see if he does. Again, SPY's starting to finally rebound back up. Yeah, Top Step has Top Step X, their new platform. It's dope, dude. I like it. I've been playing on it lately with a 150K combine going kind of back and forth, but hi. So the companies that use it might know something we don't. 30-year bond yields are terrible at 1 p.m. Yeah, the bond auction is what tanked the market. America needs a recession. Not necessarily. I saw some analysts saying sell Tesla. It's worth $196, so that's why I think the dip. Yeah, I mean, you can't necessarily trust analysts either, though. They have their own bias, you know, agendas, stuff like that. You know what I mean? Hello, I just joined the stream. Can you tell me what's going on? Yep. Jerome Powell speaks in 15 minutes on a panel for the International Monetary Fund. Powell is the chairman of the FOMC, the Federal Open Market Committee, and he has a big influence over markets. If he says something regarding the economy currently, he's almost certain to, definitely influence the markets heavily. And with that, traders usually hang on everything he says to see if he's going to really say something worthwhile that's going to influence the market. He also spoke yesterday, and that wasn't the biggest influence. But, again, this one is a panel for the IMF. And so this is a situation in which he's much more likely to speak regarding the economy and thus will probably move markets a lot more than yesterday's speech. Again, we stream everything here live like we always do, team. Today is a day in which we've been fairly red coming out the gate most of the day. Tesla is helping drag it down, although we do have some tech stocks, specifically Nvidia, that have had some crazy big runs. Regardless of anything else, what this speech will probably do is bring some volatility. At the very least, we're going to see some volatility from this, most likely. You know what I mean? We don't know when Powell is going to come on. We don't know when he's going to speak. But at the very least, this should bring some volatility for us. So, hopefully, we'll get some good stuff. Wish me luck on that. And yeah, we'll see if we do. Again, market's kind of flat right now, chopping back and forth, kind of going up and down and up and down. So we're just kind of sitting tight, waiting to see if we can get some good trades in today. And yeah, again, slap that like button, hit the subscribe button. We almost got 500 here right now. Powell makes Nvidia break 480. Yeah, Powell has been, or Nvidia has been on a crazy rebound back up. Thus is why the Q has been a little bit stronger. Here's Nvidia, almost at 470 or almost at 480. And so the market's been very strong. Is that demand zone for SPY just crashed it already? I want to pressure the great one. Nah, I don't want that. We don't want that. Yeah, we'll probably trade some more. Again, we're starting to creep up. SPY's starting to finally bounce back up a little bit here. We'll see if it does. Nvidia's nuts. Yeah, Nvidia's been what's ultimately helped the market, I think, so much lately, is Nvidia. I think Nvidia's definitely benefited the market some. You know what I mean? All right, guys, we got 500 people here. Again, hit that like button if you haven't already. We got 83 likes. We could break 100 likes pretty easily just with one more push. Was the Nvidia bounce was because of selling chip rumor in China? Yeah, so basically overseas, they banned chips. That caused Nvidia to slump. That's why Nvidia dropped back down to like 3 something. One of the news stories that came out over the last day was that Nvidia was, they had some type of way around that chip ban. And so in that regard, they were, a lot of people were getting much more optimistic regarding Nvidia, and that is kind of why Nvidia's had this crazy rebound back up. You can see Nvidia all the way back up at basically 480s. That's a very high level for Nvidia currently. So yeah, the Treasury auction, the bond auction, whatever you want to call it, is what dropped this market. This big drop right here is because of the bond auction, auction. Yeah, I can't talk right now. But yeah, if you want to see what I mean by that, so the bond auction came in at the 30-year came in at 4.769%, 4.769%. And again, that is what basically tanked the market at, when did this come out? That happened at 1 p.m. Eastern time, market time. So again, you can see the SPY down. The Q is basically down, a decent amount since then. The SPY has been pretty flat, kind of chopping back and forth. The whole market's kind of waiting for Powell to speak, though. So everybody's just kind of sitting back, hoping, waiting. Powell says good things. Here we go. We got 100 likes. Nvidia PE is like 111. Yeah. Nvidia's got a very high price to earnings ratio for sure. Given earnings, Nvidia's price to perfection. Yeah, Nvidia earnings are going to be on the 21st. AMD earnings are actually what sparked this latest microchip run, though. So it's definitely AMD earnings that started this run back for Nvidia. AMD is another microchip stock. If you look at AMD on the right, you can see AMD came in pretty favorably for earnings. A couple of days ago. I can't remember how many days ago it was, but yeah, this day for AMD, they did really well, killed it, and just flew up. So that's one of the reasons AMD is up as much as it is from earnings. All right, SPY is very flat right now as people anticipate this speech. They're going to shatter earnings for years to come. Yeah, Nvidia earnings, I believe, on the 21st. Inflation or recession mentioned. He's definitely going to mention inflation. To what degree is he going to mention it, though, is the question. Like, he's definitely going to mention it. What's he going to say about it is a different story, though. Again, Microsoft has seen some really strong moments, too, lately. Microsoft up to 360s. Definitely one of the good stocks in my portfolio right now. Apple has definitely benefited from this latest tech run over the last week or two as well. Again, the NASDAQ here, the Q, you can see at 370s currently, 370s. All right. Again, the SPY wants to hold. It's just not. Very flat. Q started to finally dip down. What smacked the market about one of the bond option? Where can I watch a speech? Right here. I mean, it might say it right below you that we're going to stream the speech right here. There also might say it in the title. It also might say it scrolling on the bottom of the screen as well, kind sir. Yeah, Microsoft's been doing great. Their AI was what, or OpenAI is what helped them. All right, good luck, no name. Utility PE like 10, Apple PE 30 with year-over-year trading growth slow. Huge bullish, guys. Watch. We'll see. I hope it's bullish. I really do. I mean, I'm a bull typically in markets. I want the markets to go up because I'm an investor as well. But it doesn't always go up, of course. All right, team, 9 minutes, 9 minutes. Stick around. Starting soon here. We got about 600 people here. Again, less than 10 minutes. All right, team. So again, the SPY is mostly flat. We got this little bitty little handle right here after a very obvious sideways chop. Again, Powell has the chance to influence this positively, though, or negatively. The SPY is already down a lot, and so I think a lot of people are just hoping he says something positive today with all the volatility. Yeah, Disney shooting up. I finally exited my Disney position, though I'm out. What's up, Kevin? What's up, John? Glad to be here once again, bro. Thank you for all your hard work and dedication. Hey, thanks so much, Kevin. Appreciate you, bro. Not really giving a 3-month dip. Thanks for hosting. I started following your channel because I'm tired of searching for a video source every time Powell speaks. Hey, just watch it here, guys. Just watch it here. You know? Yeah, we cover all Powell. Like every time Powell speaks live in the broadcast is public, we cover it. So yeah, just subscribe, hit the notification bell. We'll cover all of them, including FOMC meetings and the full speech there, press conferences, you know, Jackson Hole. All right, so we're still pretty choppy from this report, pretty choppy. All right, we got over 700 people here. Again, we got 6 minutes, team, 6 minutes. All right. Again, we're going to put the stream up live so you can see all of it. I wish they designed this a little bit better. There we go. There we go. That's better. There we go. Perfect. All right, team. Event's going to start shortly. I'm going to let me figure out how I want to maneuver my charts here. I think I'll do it like this. And then we could put, like, what do you want? Like gold on the bottom? I think I'll stack them like this. And then we can put gold or something like that on the bottom here. What do you want? Gold? We can also put like the dollar. So here's the NASDAQ, the SPY. I'm going to put gold. I can put gold. I guess I'll put gold up. I can put gold. I can put the dollar index, like the Dixie. I can put bonds. I can put like the 10-year. I could put crypto up, Bitcoin. Here's gold. Gold ripping up today too. Gold very strong right now. Let me fix this a little bit more. There we go. Slide this. How's that, chat? That looks pretty good, right? I'll zoom in like this so you could really see it. Yeah, for sure. Appreciate the love, guys. All right, team, we got 400. We got about 1,000 people here. We got about 900. Hit the like button if you haven't. We're going to throw this bad boy in sub-only mode. So if you haven't already, you know what you got to do if you want to keep chatting with everybody. Again, support free content. I don't know why people don't like me, or I don't know why haters are even out there, because everything we put out there is free. We don't charge anything. We don't have any paywalls behind anything. I promise if I really wanted to, I could put out like a sleazy day trading course, pretend to be more profitable than I was, and make millions of dollars. Like, basically, you know what I mean? Like, again, appreciate free content. I don't claim to be an expert. My channel is called Beginner Trading. I just wanted to give people an anti-guru channel who didn't claim to be, you know, some super rich day trading guru driving a Lamborghini in a mansion. So subscribe. Again, we cover all the economic reports, CPI, PPI, Jerome Powell press conferences, jobless claims reports were this morning. We cover all that stuff completely free. We cover it very quick. The reason we get thousands of people that tune in, like jobless claims, we had over 1,000 people here this morning because we cover the data quickly when it drops as well. CPI drops next week. If you want a quick channel that reports it fast, subscribe. Appreciate the love. And yeah. Hey, thank you so much, Russ, my guy. Thank you so much, dude. Haters gonna hate. Baller's gonna ball. I mean, to be honest, I drive a pretty nice car. Like, I live in a very nice house. Like, look, I got a freaking library, you know? But I don't need to, like, flex it all the time because I'm not trying to sell a course. And so, like, me flexing just shows insecurity. Like, too much flexing on the internet just shows insecurity. I'd rather privacy, to be honest. Whoa, what is going on? Where are these words coming from? What? I'm sorry, guys. Can y'all hear the music? Oh, that's a great thing. It reminds me to change my headphones out. It's actually a blessing that guy just came on here, started rapping on my channel, because that reminds me to switch this so that I can switch to my fully charged headphones, because this is gonna be a long speech. This thing's like an hour and a half long. Yeah. All right, guys. Also, prior to that, let me put the music on. Can you hear this music right now? Hold on, let me stop. Can you hear the music? Right. Can you hear the music? Yeah. Hey, thanks, team. Bears will hunt the Bulls. 10-year will hit 4.6. Yeah, if we look at the 10-year right now, it's at 4.6. 10 years over 4.6. It's at 4.602%. It went all the way up to almost 4.7, or like 4. It went up to 4.6 and a half. This is what the 10-year went to. So yeah, SPY still dipping. Looks pretty dippy. Can you hear the music, guys? Somebody help me out. Livingston, where? Livingston, Louisiana. Is today the most he will affect the SPY and market? Nah, the FOMC meetings are probably going to affect it much more than anything he says today. Okay, good. Y'all can hear the music. All right. All right, so I'm going to mute the channel now, and then I'm going to turn the music off, and then I'm going to put... Okay, so we're completely live. And now we're just kind of waiting for them to start this panel. Make sure we're completely live. Make sure. Okay, yeah, we're good. Yeah, they turned the music off, I guess. I'm also going to check another source just to make sure you get the most up-to-date stream. All right. All right, guys, they should start anytime. I'm going to take this timer off. Now we're at the whim of them. SPY's starting to dump down, though. SPY just broke lows of the day just, really quickly here. All right, so yeah, we're watching this from all the different sources. We don't see anything yet. Let me see when Powell's actually supposed to speak. Look at the market dip. What happened? Huh. All right. Powell is supposed to speak from 2 to 3:30. So we're on the lunch break still. We're just kind of hanging out waiting now, I guess. The Mexico interest rate was at 11.25%. All right. So they're about to start it up real quick right now. Again, I'm trying to make sure I give you guys the most the most real-time stream they have. And so, again, subscribe if you appreciate it, because we're going to try to give you guys the... Okay, y'all can hear this, correct? I can hear it now. Powell says we're not confident we've achieved sufficiently restrictive stance. If it becomes appropriate to tighten policy further, we will not hesitate. End quote. Y'all can hear this, correct? Yeah, so here, this is what market dropped the market.
And the theme for this policy panel is a theme that is going to resonate with all of us, of course, monetary policy.
Can you hear now?
In a global economy. Now, as we all know, in recent years, the global economy has been going through a major inflationary episode. Pretty much every country, everywhere, with a few exceptions, have seen inflation rates that they had not seen in many decades. This has been accompanied by a number of additional shocks as well. A war on the European continent, an energy crisis, rising trade, geopolitical tensions. And of course, in response to this surge in inflation, central banks in many places have tightened monetary policy also to an unprecedented degree in a long time, including in the US, but in many other places as well. Now, the good news is inflation is on a downward path in many places, even though it remains still quite high and above desired levels. And many central banks now appear to be near or at the peak of their hiking cycles, so they are communicated about that. So while we're not home yet, is an important time to take stock. And this panel will aim to shed some light on the trade-offs and the challenges that policymakers face today. Has the monetary policy response been sufficient? Has it been effective? What can we say about spillovers? And more broadly, is the central bank toolkit fit for the task at the current juncture? Now, to help us think about some of these very complicated issues, we have a really phenomenal panel today. I really cannot think of a set of people who would be more qualified to share their views on these questions. So I'm going to introduce them briefly in the order in which they will speak. We'll start first with Jay Powell. We're very fortunate to have Jay with us. Jay is chairman of the Federal Reserve System since 2018. Arguably, many would say, the most powerful policymaker in the world. He served as a member of the Board of Governors since 2012. Prior to the Federal Reserve Board, Jay worked in investment banking. He also served as Undersecretary of Treasury for Domestic Finance in the George W. Bush, H. Bush administration. Amir Yaron has been governor of the Bank of Israel since 2018. That is for almost as long as Jay's tenure as chairman of the Fed. Before that, Amir was professor of banking and finance at the Wharton School of Business at the University of Pennsylvania. And he's a world-renowned expert in macroeconomics, monetary economics, finance, and financial economics. And we're particularly delighted to have Amir with us today. Geeta Gopinath requires no introductions, I think, especially in these walls, but she is the first deputy managing director of the International Monetary Fund. Previously, Geeta had my job as chief economist and head of the research department. And prior to joining the IMF, she was the John Swanstra Professor of International Studies and of Economics at Harvard University, with a world-class record of research on exchange rates, trade, and investment, international financial crisis, monetary policy, debt, emerging market crisis, a very, very long and distinguished list. And then last but obviously not least, Ken Rogoff. Ken is the motivation for this year's annual research conference in his honor. And we're very happy to have him today and tomorrow. And currently, the Moritz Boas Professor at Harvard University, also a former chief economist at the IMF in 2001, 2003, another turbulent time for the global economy. Ken has written several extremely influential books and, of course, many, many research articles on debt and financial crisis. He has written what remains to this day a reference textbook, graduate textbook in international macroeconomics with Ken Rogoff in 1996. Is known for, with Maury Upsfeld in 1996, is known for his pioneering work on exchange rates, central bank independence, sovereign debt, financial crisis, among many other topics. And Ken has long ranked among the most cited economists. I checked quickly, and I think his REPEC ranking, which is something us for academics or former academics, we check carefully very often. I think his REPEC ranking is number 11, which is totally astonishing. And his Google Scholar count is, off the charts, astronomical. And for those of you who don't know, I have to all mention this, Ken is also an international chess grandmaster. Now, we will start with short interventions from each of the panelists for about 10, 12 minutes, followed by a quick discussion between them, and then we will open for discussion with the audience. There are mics in the aisles. If you are at the point at which we reached that stage in the panel, if you want to ask a question, please line up behind the mics, and then you will have a chance to do that. I will only ask that, since our time is counted, that you keep your questions brief, and you also keep them focused on the topic of the panel, which is monetary policy challenges for the global economy. Now, with this, let's start with Jay. I believe Jay will talk about the nature of the inflation process in the US and the appropriateness of the monetary policy response. It's up to you, Jay.
Here we go. Here's Powell. Say something good, Powell.
Thank you very much, Pierre-Olivier. It's great to be here, particularly in honor of Ken, whom we're proud to count as a member of the Fed family. So my assigned topic is U.S. monetary policy in the current global inflation episode. So I'll begin by briefly addressing the U.S. outlook, and then I'll turn to three broader questions raised by the historic events of the pandemic era. So to begin, U.S. inflation has come down over the past year, but remains well above our 2% target. My colleagues and I are, of course, gratified by this progress, but we expect that the process of getting inflation sustainably down to 2% has a long way to go. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we expect growth to moderate in coming quarters. Of course.
Jerome Powell, by refusing to treat climate change like a systemic risk
Thank you.
you are putting us.
Thank you very much.
disaster.
Thank you very much.
Climate change
Yep.
will threaten
Thank you. Just close the fucking door. Close the door.
Bro, this is the second speech I'm talking about South. This is the second speech I've covered by Powell where the environmental activists storm the stage and say all this stuff, bro. They are lurking in the shadows, waiting for him to come out and speak, man. This is the second speech in a row. They did this like a week and a half ago when Powell spoke. I can't remember what he spoke about. But he spoke like a week and a half, 2 weeks ago, maybe 3 weeks, and they did the exact same thing. The exact same thing happened where the environmental protesters come out and they storm the stage. They have to turn the stream off for a second and then come back on. Yeah, the same exact thing. Don't worry, they're going to get it straight. This has happened twice in a row now, where these environmental activists storm the stage and shut it down for a second. Yeah, this is again, it's kind of funny. I can't lie. They did the same thing. They're legit lurking in the shadows. Yeah, dude, these environmental actors, they're cutthroat, man. They're doing whatever they got to do. Honestly, yeah, Powell leaves the stage at the IMF event after protesters. He'll be back. Don't worry, guys. Again, they shut it down. This is the second time in a row that this happened. Like last time, again, I don't mind because it lets more people come here. I'm gonna have to post this so people understand. Breaking environmental protesters storm stage again. Delay Powell speech. We'll resume shortly. And I'm gonna throw in an LOL just for fun here, because man, dude, this is the second time in a row this is happening. The meeting's not over. They're gonna come. They're gonna get it back. Honestly, it's just gonna delay the meeting a little bit, which is fine. But yeah, no, it's not over. They're rushing the stage. This is the second time in a row that this happened. I don't know what Powell said. Close the freaking door. Did he say that? I didn't hear him. Yeah, there's no video right now. It's paused. Like both of them are paused. Again, I'm watching both of them. Like a lot of different ones. They're both paused right now. Nothing's going on. Yeah, they're both paused. No hold music or anything like that. Again, this is the second one in a row. I'm trying to remember the last one that happened. Like the last one that Powell spoke. Powell spoke not too long ago, and again, I can't remember what it was. Chat, you guys might be able to help me with this. Man, all right, guys. Again, bear with us. They're gonna have to start interviewing Powell. Man, my guy's saying my guy Powell saying I'm tired of this. Get these activists out of here. I didn't hear what they were yelling last time. Last time I wasn't able to actually hear what they were like. I didn't know what kind of activists they were last time. But yeah, again, you guys know I do this out of just the kindness of my heart here. I would never, do this for money reasons. But if you want to check out our sponsors, help support the channel, check out Top Step. If you want to day trade with less risk. Most day traders lose money, so you can either put up thousands yourself and risk losing that, or you could try Top Step. $49, you're going to get
interlude.
Okay,
of course,
hold on.
Climate issues are important.
Okay, they're back.
And they're appropriately addressed. But as I mentioned, we'll try to keep the questions on the topic for today. Okay. So monetary policy challenges for the global economy. Thank you.
Where's Powell?
And
Powell's like, I'm tired of this.
yeah.
I told you they'd be back. Again, if you want to check out Top Step, here's the link
Let me check.
while we're waiting. Okay, now they're muted again.
We might have to go to.
Where's Powell? Powell get rushed out of there, man. That happens. Again, this is like, I need some popcorn. Honestly, I might go make some popcorn. This is entertaining. Okay, here he comes. There he is, the man, you know. He's back. He's like, look, yo, I'm tired of these environmental activists. He's tired of it.
No, don't worry about it.
There he is.
Okay,
Yeah,
where
look.
was I? Inflation was coming down. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we do expect growth to moderate in coming quarters. Of course, that remains to be seen, and we are attentive to the risk that stronger growth could undermine further progress in restoring balance to the labor market and in bringing inflation down, which could warrant a response from monetary policy. The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. We're making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity, inflation as well as the balance of risks, as we determine the extent of additional policy firming that may be appropriate to return inflation to 2% over time. And we'll keep at it until the job is done. So with that, let me turn to the three questions that I've posed that have arisen from the receding but still elevated inflation we're experiencing today. The first question is, with the benefit of 2.5 years to look back, what we can say about the initial causes and ongoing policy implications of the current inflation. After running below our 2% target over the first year of the pandemic, core PCE inflation rose sharply in March 21. Economic forecasters generally did not see this coming, as shown by the February 21 survey of professional forecasters, which showed core PCE running at or below target over the subsequent 3 years. So the real-time policy questions for policymakers were what caused the high inflation and how policy should react. And at the outset, many forecasters and analysts, including FOMC participants, viewed the sudden upturn in inflation as mostly a function of pandemic-related shifts in the composition of demand, a disruption of supply chains, and a sharp decline in labor supply. The resulting supply and demand imbalances led to large increases in the prices of a range of items most directly affected by the pandemic, especially goods. In this view, as the pandemic abated, our dynamic and flexible economy was likely to adapt fairly quickly. Supply disruptions and shortages would diminish, labor supply would rebound, aided by the arrival of vaccines and the reopening of schools, elevated demand for goods would shift back to services, inflation would ease reasonably quickly without the need for significant policy response. Indeed, although monthly core PCE inflation spiked in March and April of 21, beginning in May, it declined for 5 consecutive months, providing some support for this view. But, of course, in the fourth quarter of 21, the data clearly changed amid waves of new COVID-19 variants, with only gradual process in restoring global supply chains and relatively few workers rejoining the labor force. That lack of progress, combined with very strong demand from households, contributed to a tight economy and a historically tight labor market and more persistent high inflation. The committee signaled a change in our policy approach and financial conditions began to tighten. Of course, a new shock arrived in February of 22 when Russia invaded Ukraine, driving up prices of energy and other commodity prices. By the time we lifted off in March, it was clear that bringing down inflation would depend both on the unwinding of the unprecedented pandemic-related demand and supply distortions, and on our tightening of monetary policy, which would slow the growth of aggregate demand, allow supply time to catch up. Today, these two processes are working together to bring inflation down. The FOMC has raised the federal funds rate target by 5.25 percentage points, and we've reduced our securities holdings by more than $1 trillion. Monetary policy is in restrictive territory and putting downward pressure on demand and inflation. The unwinding of pandemic-related supply and demand distortions is playing an important role in the decline in inflation. For example, wage growth has steadily fallen since mid-2022 by most measures, despite continued robust job gains, reflecting a resurgence in labor supply, thanks both to higher labor force participation and a return of immigration to pre-pandemic levels. While the broader supply recovery continues, it's not clear how much more will be achieved by additional supply-side improvements. Going forward, it may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth of aggregate demand. Turning then to my second question. For many years, it has generally been thought that monetary policy should limit its response to or look through supply shocks to the extent that they are expected to be temporary and idiosyncratic. Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the trade-off presented by those shocks. Supply shocks tend to move prices and employment in opposite directions, whereas monetary policy pushes each in the same direction. Therefore, the response of monetary policy to higher prices stemming from an adverse supply shock should be attenuated because it would otherwise amplify the unwanted decline in employment. In addition, supply shocks have most frequently come from the volatile food and energy categories, and they've passed through quickly. While food and energy prices critically affect the budgets of households and businesses, the policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint in this case is also good risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of makeup strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2024 and announce the results about a year later. Among the questions we will consider is the degree to which the structural features of the economy that led to low interest rates in the pre-pandemic period will persist. With time, we will continue to learn from the experience of the past few years and what implications it may hold for monetary policy. These are just 3 of the many questions raised by these challenging times, and of course, we're very far from a complete understanding of the answers. Again, it's great to be here today, and I look forward to our conversation. Thank you.
All right, so that's his speech aspect. He's also, they're going to do a Q&A where they ask questions
Jay, and
as
I think
well.
we're really off to an excellent start with your remarks. Let me now turn to Amir. Amir, Israel is a small open economy, faces very specific challenges. Like the US and many other countries, it's seen an increase in inflation in recent years, and the Bank of Israel has been acting on it. In addition, like other small open economies, it faces potential spillovers from monetary policy decisions taken elsewhere by major central banks, with a potential impact on currency and capital flows. And we'd love to hear your views. So, Amir, floor is yours.
All right. First, it's a pleasure to be here in a conference in honor of Ken Rogoff. We all cherish and follow his distinguished contribution in academia and practice. Sort of in a sharp turn, as we're all aware, Israel is currently at a war following the October 7th inhuman, brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our hearts are with the innocent victims of the war, and our hope is for it to end with a safe return of hostages and with peace and security. And now I'm going to turn now. I want to turn now to address the issues and questions presented for this session. An important question is, to what extent can a small open economy like Israel, or for that matter, any SOE, conduct its monetary policy independently, or should it rather follow the steps of the major economies? Another question is, what are the spillovers from the policy taken by the major economies to small open economies, and how do those impact local conditions? The answer to these questions depends on the development of the economy, its specific areas of exposure to the global economy, and the particular shock it might need to react to. Generally, local monetary policy cannot be entirely disconnected from that in the major economies. Yet, local circumstances justify and require setting policy that is tailored in accordance with the economy's structure and needs. Key considerations will include interest differentials, foreign exchange, and the effect on domestic activity, in particular exports, and on inflation, and on financial markets. As we all know, our planet has become a small village. The COVID experience demonstrated the spillovers that can result from a common shock. Monetary policy was generally similar in many countries because the initial health shocks, as well as many supply-side difficulties, were similar. Also, we benefited to some extent from the common monetary framework, such as inflation targeting. And that meant that monetary policy in different economies was predicted to act in a similar manner. Having said that, the differential health shock and related steps, fiscal policy differences, and exposure to supply-side effects and commodity prices led to somewhat different policies, consequent inflation, and activity outcomes. Consequently, there was more heterogeneity in monetary policy exiting COVID than upon its entry. Israel was fortunate in that sense, with relatively small share of tourism sector and a relatively large high-tech sector, which actually benefited from the increased dependency on remote work. These circumstances led to a wedge between global monetary policy and the required domestic monetary policy. This slide shows that for these reasons and others, inflation in Israel is in the lowest quartile of rates in the OECD. In particular, headline inflation in Israel was low because its natural gas supply and prices were shielded from global developments. The next slide shows the swift recovery of the Israeli economy from the COVID crisis. The level of GDP exceeded its long-run trend already by the end of 21 and stayed somewhat above this trend by Q3 23. And we'll come back to this recovery ability of the Israeli economy. An additional key attribute in Israel that affects potency and effectiveness of monetary policy is the large share of mortgages that are directly tied to the Bank of Israel. Therefore, raising rates influences the stock of almost all homeowners, not just new ones. This is another cause for possible differences between global and local monetary policy decisions. The Bank of Israel was one of the first central banks to respond to the increase in inflation. As a first step, we shrank the unconventional tools employed during COVID, that is, QE, FX intervention, and special funding to commercial banks. Relative to its rate of inflation, Israel has been among the first movers. This is another evidence for only partial dependence of SOE on policy taken by major central banks. Here you could see the relative time it took to get into a restrictive zone. The policy the Bank of Israel has in fact set in recent years is consistent with this approach. We are aware of the fact that domestic monetary policy cannot deviate too much from global conditions, but at the same time, we recognize that policy should be set according to specific shocks to our economy, taking into account its fundamental attributes. And you could see over some cycles are shared and some are not. Let me show you some specific shocks. We learned over the years that there is a strong connection between the S&P and NASDAQ indices and the shekel dollar exchange rate. This is because Israeli institutional investors react continuously to changes in the value of their foreign denominated portfolio. This slide shows this pattern very clearly. The orange tracks the blue. However, as can easily be seen, since the beginning of 23, this strong connection has weakened. This was the time period that potential changes to the judicial system ignited a widespread civilian opposition. Similarly, the Israeli and US stock markets, who tend to move together, also displayed a weakened connection. According to the assessment done at the bank, if the exchange rate were to follow the NASDAQ in the pattern with the NASDAQ index, according to the previous periods, the shekel would have been about 15% stronger relative to the actual foreign exchange rate in September 23. You see it in the gap at the end. Given our estimates of the foreign exchange pass-through to inflation, this amounts to about 1 to 1.5% additional inflation. This demonstrates, again, the power of local significant developments that might have on financial markets, on inflation, and therefore on policy. I want now to move and discuss current developments in relation to monetary policy. An important part in the analysis is, of course, the initial conditions. The Israeli economy is strong and stable. It has robust and healthy economic foundations. We are a global leader in innovation and technology. The Israeli economy has known how to function and to recover from difficult periods in the past and to return to prosperity rapidly. I have no doubt that the same will be the case this time. You could see the growth rate after different military events in the past. Importantly, over the years, Israel has shown responsible fiscal position as demonstrated by the declining path of the debt to GDP ratio. Israel entered the war with a very solid fiscal stand. Our debt to GDP ratio is just under 60% and a budget deficit which was expected to be 1.5% in 23, following a surplus in 22. There is no doubt the war will have fiscal implications and generate budget pressures. according to initial projections of our research department, which of course, and I cannot emphasize this enough, are accompanied by extreme uncertainty. And assuming the war is primarily concentrated in the southern border and lasts till the end of this year, GDP growth is likely to shrink by about 1% in 23 and 24, and the debt to GDP ratio is likely to rise to somewhat more than 65% by the end of 24, as costs are larger than it was initially projected. As I mentioned in my opening, Israel has been in a war for a month now. Above and beyond the vast human, security, and political consequences, there is no doubt this is a major shock to the economy, to households, workers, and businesses. Economic policy, fiscal, and monetary, which we in the BOI lead, takes the necessary actions in order to alleviate the difficulties accompanying these challenging times. With the outbreak of fighting, significant depreciation pressures were seen, which were reflected in early trading in foreign markets. The Bank of Israel responded rapidly. Already on October 9th, before trading opened, we implemented a plan to sell up to $30 billion of reserves and to put into operation swap transactions totaling up to $15 billion. Within the framework of the program, the bank is acting in the market to moderate the fluctuations in the value of the shekel and to supply the liquidity required to continue the orderly activity of the markets. The initial high level of the Bank of Israel's foreign exchange reserves at about $200 billion, 40% of GDP, gives us ample space to act to achieve this target. In addition, the bank also put into operation a shekel repo transaction plan and a monetary program focused on small businesses. In parallel, and that's the other side to the approach, from the beginning of the war, the Bank of Israel rapidly formulated a uniform and agreed upon framework that was adopted by the commercial banks and was expanded to credit card companies as well. The framework is focused on those serving in the Army reserves, the population on the borders, and the families of the victims and hostages. These populations will be able to defer for 3 months payments on mortgages, consumer credit, and small business credit without costs. Many of the banks have extended these steps, a very welcomed outcome, as they are stable, resilient, and have ample capital buffers. In our interest rate meeting on October 23rd, we kept the policy rate at 4.75. This is consistent with the bank foreign exchange activities and inflation endeavors. This array of policy steps that were taken by the bank in the last month reveals the sufficient and necessary independence that the bank enjoys and that it has the adequate set of monetary tools that can ensure financial stability. Avoiding a reduction in the rates is in line with operating in the FX market to moderate large depreciation fluctuations. Moreover, the steps taken by the bank vis-a-vis the banking sector allow in practice some monetary easing, but targeted at those who need it most, without compromising the need to deal with increased risk premia in financial market. Let me say, 1 month in, we can cautiously say that the policy mix we applied contributed to the stability not only of the FX market, but also had positive spillovers for the stability of local financial markets. The developments in the markets also indicate that the public understands that the BOI enjoys the required independence in order to take the necessary steps at these times. Inflation expectations, as you can see in the slides, for the short term and the long terms have remained substantially stable and are stating that we will be back in the inflation target. The exchange rate has depreciated a lot, but by now is back to the level prior to the war. So you could see the red line, this depreciated more than previous military events, but it's now back to where it was. Let me finish here. Fiscal policy is, of course, central and crucial for the ability of the economy to overcome this crisis and to resume growth in the medium and long term. The government is working on various fiscal support plans, which the bank is playing a key role in advising in its role as economic advisor to the government. The bank has stated the importance of finding a responsible balance between supporting the economy and maintaining a sound fiscal position. While it is clear that overall fiscal needs will increase, the bank advice is and was to utilize the 23 budget, yet demonstrate fiscal responsibility by introducing several important adjustments and cuts in less necessary activities in 23 and 24 budgets. I'll finish here. I have no doubt that, as always, Israel will prevail and has the right ingredients to spring back to its great economic potential. We all hope for calmer and more tranquil times. Thank you.
Thank you. Thank you very much, Amir. We will now move to Gita. Now, of course, in light of what both Jay and Amir have told us, I think the question in front of us at the fund is, how to think about the challenges for central banks and whether central banks have the appropriate toolkit at the current juncture. And I think everyone will be very grateful to hear your views, Gita.
Thank you so much. And firstly, as a former student and colleague of Ken, I'm really glad that we're able to honor Ken Rogoff's tremendous contributions to academia and to the policy world through this conference. So as Pierre-Olivier said, what I'm going to talk about is some of the challenges that monetary policy making faces in this current inflation environment. I think it's fair to say that we are living through a period of heightened uncertainty. We know that there are multiple shocks that the world has faced, and unprecedented shocks, the pandemic, wars, conflicts. The uncertainty that I want to emphasize, though, here is about how the current episode of monetary policy tightening has not been your typical monetary policy tightening episode. And that generates its own source of uncertainty about how to go ahead. So what exactly do I mean by that? So yes, we have had inflation go up quite dramatically in many parts of the world. And central banks have appropriately raised interest rates quite sizably in this last year and a half, couple of years. And we've seen inflation decline. All of this is standard. But if you look under the hood, I think what is highly atypical is that this decline in inflation has not come along with a rising rate of unemployment, a significantly increase in the unemployment rate, or a significant slack in the labor market. This is atypical because usually the way we think of policy affecting inflation is to reducing aggregate demand, and then that shows up in the labor market through higher unemployment. Now, this is true if you look at the US, you look at the Euro area, UK, but also several emerging markets, including Mexico, if you look at emerging Europe and several others. So what has helped? How have we gotten a bunch of this inflation decline? Much of the work has been done by improved supply. And here I'm talking about the decline in energy prices and food prices that have helped bring down headline inflation. The improvement in global supply chains have helped bring down core goods inflation. The business that's still left is when you look at services inflation, where variables like wage growth play a very important role. And core services inflation, or more services inflation more generally, remains elevated. So in that sense, the job is not done. But this can be tricky in terms of communication, because on one hand, you see inflation all headed in the right direction. But on the other hand, you realize that this last mile will likely be the toughest. So if you look at measures of core services of inflation, let me just give you a couple of numbers. The US is now at 5%. The euro area is at 4.5%. These numbers are well above central bank targets. Okay, so what does that mean in terms of policy going forward? The first point that I'm going to make is that that means that it's important to avoid premature easing of monetary policy, either through action or through words. Now, this is going to be a challenge because we are living in a difficult period in terms of reading the signals. We are going to see labor markets have greater slack. We are going to see unemployment rates go up. So that's going to be a difficult message to stand by and say that, well, we have to make sure that we get the job done. The other reason this is going to be a challenge is because we have lived through a period of inflation that's been high, and the persistence of inflation makes it more difficult to then see through supply shocks, something that Jay mentioned, which is that we still live in this environment where there are numerous potential shocks that can hit the world economy, including the terrible conflict that's in the Middle East that Amir talked about. If it were to spread into a more regional conflict, we could see a sharp increase in oil prices. That will then affect headline inflation numbers. And in an environment where inflation has been high for a while, that can dislodge short-term inflation expectations. And our research has shown that it's very important what's happening with short-term inflation expectations. Because if you can keep that close to your target, then that makes the job of central bankers much easier in being able to bring down inflation while at the same time not needing a big loss in terms of output. So it improves the odds of a soft landing. The other challenge that comes up is what's happening with long-term rates. We've seen long-term rates in the US go up quite significantly in the last several weeks. It's bounced around a bit, but still these are much higher numbers than in the past. So this raises a question, which as a policymaker, does this mean that then you don't have to do the next interest rate hike, if that's what you were thinking about doing? Because now you're getting the effect that's working through higher long-term rates. And here again, this is tricky given the uncertainty. So let me just explain, which is it depends a whole lot on what's driving the higher long-term rates. If the higher long-term rates are being driven by expansionary fiscal policy, then in fact, a higher long-term rate should actually signal a need for even more monetary policy tightening to offset the expansionary effect that it's having on the economy. In the US, where you're seeing most of these interest rate increases, the US fiscal deficit is around 8% this year, and it's projected to be around 7% over the next 3 years. Now, there is a question mark of how stimulative that is on the economy, but when you have high levels of deficits, that certainly is something for a central banker to also incorporate when they're trying to make their forecasts about the path of inflation. My second point about what it means for policymaking in this environment is that central banks must be prepared to respond to renewed financial stresses, especially if inflationary pressures persist. So again, there is the last mile that has to be done, but if inflation remains far more stubborn or further it goes up in some more because of other shocks, then that will require interest rates to stay even higher for longer or even increase. And we could be then in a situation where you have an inflation problem while at the same time growth is slowing sharply. So that's a stagflationary environment that one could have, and one certainly should not rule that out. In that scenario, again, some of our research has shown that we would have a large number of weak banks that represent about 1/3 of global assets, mostly located in advanced economies and in China. That would be a very difficult place to be in, which is why it's important to prepare in advance. This is the time for strong supervision, robust stress tests, and it's also important for banks to be able to augment their capital buffers at a time when they're making currently very high profits. Banks should also be prepared to quickly access central bank facilities if needed, so that we don't have a repeat of an SVB phenomenon. And much more efforts need to be made to address the risks in the non-bank sector. The third point I'd like to make about policy in the current juncture is that policymakers have to be prepared for more cross-border pressures from increased divergence across economies, increased divergence in policies across economies. So let me give you an example. If you compare 10-year yields in China in its own currency to 10-year yields on US Treasuries, for the first time, the numbers have flipped around. So we actually have yields in China Treasuries, 10-year Treasuries are now around slightly less than about close to 2% lower than the yield that you can get on US Treasuries. Now, that obviously puts lots of pressure on exchange rates. And so I'm going to conclude with a few thoughts on what it means for a central banker, especially of a smaller open economy that's facing pressure from weakening currencies in this environment where yields could look very different for a while. This is based, by the way, on a lot of research that we've been doing in the fund. It's called the Integrated Policy Framework. Okay, so first, what does this mean for exchange rate interventions? I think the important thing for central bankers to keep in mind is first that the exchange rate movement is being driven a lot by fundamental shocks. So it is being driven to an important extent by interest rate differentials, which means that in such an environment, exchange rate flexibility has a very important role to play, and it helps you with adjusting. But of course, on the other hand, what can happen is in an environment of heightened uncertainty, you could see exchange rate movements entering zones that then pose a risk in terms of financial stability concerns, especially if you have shallow FX markets. And there's also this risk, which I often hear, that you might have exchange rates going past some psychological thresholds, which then can lead to non-fundamental behavior in these markets. So in this environment, of course, in these specific cases, FX intervention can play a useful role. But this is going to require judgment, and this is the hard part, which is telling apart when is it truly fundamental and when is it non-fundamental for which intervention should happen. I think the basic policy has to be not that the only thing that matters is if you see a sharp movement in the exchange rate. A sharp movement of the exchange rate can truly reflect differences in fundamentals. But it has to be a sharp movement in exchange rate that then interacts with some friction in the economy. And you can see that through, say, deviations in uncovered interest parity or covered interest parity that then tells you that this shock is getting amplified through frictions, for which you certainly interventions can help. And the last bit on FX policy is just to remember that there is no free lunch. Countries have a certain amount of FX reserves. If you use it, deploy it at a time when it's not really needed and prematurely, then that, of course, means that you're going to have less to use when you are in a more difficult period. So with that, I have 30 seconds just to conclude and just to remind everybody in terms of the 3 points I made, which is firstly, the job of bringing down inflation is not done in many countries, and that requires that you to avoid premature easing of monetary policy, either through action or through how you communicate. Second, it's important for central banks to be prepared to respond to renewed financial stresses and also to buffer the financial system. And third, for policymakers to be prepared for more cross-border pressures because of increasing divergences in policy stances across economies. Now I'm going to stop there. Thank you.
Thank you, Gita. And I will now turn to Ken. Now, of course, Ken, your own work, both when you were in policy, but as an academic, over many, many years. You've touched on all of these issues. And I think, as many people have mentioned already today, your both sets of contributions, academic and policy, completely irrigate our own thinking on these matters. And so I think we're very eager to hear your views on all this.
So first, I want to thank the IMF for hosting this conference, and particularly this panel, Pierre, Olivier, Amir, Jay, and Gita for participating. Jay, I certainly appreciate how valuable your time is, and Amir, I don't know how you found time to come here, but thank you. It is an extraordinarily difficult period, and in terms of shocks. And I know when you're giving the World Economic Outlook, Pierre-Olivier, we probably always say that. But one of the things here, celebrating my 70 years, I've been around the block. And this is pretty bad. I mean, I think you'd have to go back to the 70s to think about a period that really compares to this. And even if you don't encompass the global financial crisis, but just have the pandemic, and I don't know how to say this, apolitically, but the rather radical shifts in US policy from one president to the next, and the various implications of that, the pandemic, war in Ukraine, now war in the Middle East, and this really fragmentation of globalization is really something extraordinary, and is a very difficult period. I think that has implications for a lot of things, for policy, for macroeconomics. However, before I get into that, I want to say, I can think of, there is sort of one silver lining, and I must hesitate to say it, because if I'm identifying something the IMF seems to have done right, then it may immediately go wrong. But the thing that has surprised me, and it surprised me a lot, is how we've had the pandemic, global recession, rising interest rates, inflation, and we have not had a major emerging market debt crisis. Forgive me, Argentina. We just haven't had it the way that we thought we would. You can go on to other markets. It's really stunning. And again, we don't know what's around the corner. But I actually would give the IMF a little credit here. And there was all this, for years, talk about the Washington Consensus and the evils of the Washington Consensus. And you may not have followed it, but there were many alternatives, notably the Buenos Aires Consensus between the presidents of Venezuela, Argentina, and Brazil, back in the early 2000s, and much praised by many progressive economists. And without going into the details, I would say the way people characterized the Washington Consensus was something of a caricature. It wasn't, it's sort of picking extreme versions of each policy. And yet, if we look at why haven't emerging markets had a financial crisis, it's, in a sense, they've adopted, at least in the macro sphere, and probably particularly in the central banking sphere, some version of the Washington Consensus. Now, one was to have a lot of reserves. That's really not in the Washington Consensus, and the Japan and the Asian economies deserve credit for that. And now everyone's imitated that in a dollarized world, it provides a lot of resilience. But there are certainly other elements. Regulation's gotten a lot better. And I have to say, whenever I had to sit in on meetings about regulation when I was IMF chief economist, I was sort of bored by them. But actually, it's one of those things where you do your homework and it really pays off. For example, forcing banks in emerging markets to match their dollar assets and liabilities, something really important. And not just that, but the knowledge that many emerging market central banks have about what's going on in their economies, the data that they keep track of. Certainly central bank independence, which I'll talk about in a minute much more, that's been an extraordinary development and allowed many of these things to persist. So anyway, that has been a silver lining in a very difficult situation. So I'm going to pick up on a couple topics. I want to start with interest rates, and I'm not going to talk about policy, but just talk about where do we think long-term interest rates are going. I think, like any financial variable, it's actually very hard to know. But I think if you take a very long-term view of long-term real interest rates, and I gave a paper at this conference last year about it, and done other work with Barbara Rossi and Paul Schmelzing, you see that over the long run, there is a very gentle decline, but it's much more gentle than we've seen over the last 40 years. And there's been sort of a lot of work trying to rationalize what happened over the last 40 years in terms of demographics, productivity, secular stagnation, that I have always submitted has been overblown. And if you look at these longer periods, it's just, some of what seems like a structural change is just another kind of big shock that comes along. We've had periods where interest rates have been low, periods where real interest rates have been high around this trend. And typically when you see a really big shock, first, like after 2008, where global rates fell, by some measures, up to global 10-year inflation index rates over 3%, you should never have expected that to be permanent. And of course, the same might have been true how much it rises here. It's difficult to tie the trend exactly, but what is certainly true is long-term rates typically are very volatile. That was somewhat masked during, I think, this period, particularly of the zero bound, which the chair of the Fed has talked about, where the central banks just couldn't do anything. And that provided, I think, took away some of the volatility. My own guess is that we'll be looking at significantly higher interest rates, certainly at least like they were a year ago. And I'm talking about forward-looking real interest rates, and perhaps higher for the rest of the decade or more. Again, there's volatility around this, and I'm talking about the long rate, not the short rate. And yeah, I think there are many reasons for this, but one is deglobalization is probably puts upward pressure and fragmentation on interest rates, both in terms of risk premia and in terms of where savings goes. Another thing I have to say, unfortunately, is there's, in addition to the green transition, we are looking at a decade, 2 decades of much higher spending on defense globally. I've been to conferences at the IMF not so long ago, and Olivier knows this, not him as a speaker, but we were jointly organizing one where one of the speakers insisted, well, we never have to spend anything on defense again. So, the interest rates are low, everything's a free lunch, and we should take advantage of that. Unfortunately, that was very sanguine, and we're in a more difficult period there. I've mentioned the green transition. Inequality is something which has put probably downward pressure on interest rates, but there's strong pressures in the other direction. Let me say a few words about central bank independence, which I think it has been incredibly important to maintaining stability that we have. And it's something that's become very important worldwide. I have to mention, when I was at the IMF as a very junior economist, I don't know what it's like now, but you were only allowed 1 chair in your office for you, because who would want to visit you? That was what people said. But I wrote a paper inspired by Paul Volcker on how central bank independence might help with the inflation problem of the day. And I wrote about the original title of the paper had inflation targeting in it, but it has inflation targeting in it and looks at intermediate targets. I will finally also say that I mentioned this morning about how hard it is to get papers published when you're junior. I couldn't get this one published. I submitted it. One place I sent it was to the JP, where Barrow sent it back by return mail saying, look, there's not going to be an institutional solution to this problem. It's a super game. I got it rejected by IMF staff papers at the time. But I think it's certainly something where it's become very successful. I will say that in sort of trying to apply it, you have to have some humility. You can't think there's some rule that just explains everything. Your inflation targeting rule, the world changes. And models, let's face it, are particularly bad at turning points. If your model's predicting that tomorrow's going to be sort of like today, we do really well at that in those models. They're very complicated versions of that, but they're all the same. But when you have a big turning point, and we might have a turning point now because of many factors, it's more difficult. So let me just talk about a few of the pressures on central bank independence today, and it's a fast-moving thing. And so I'm not even sure I'm nearly up to date. But during the zero-bound era, people said, well, you don't have anything to do to central banks. So you should solve inequality. You should solve the environment. You should solve racial justice, and on and on. And you can see this in central banker speeches. I haven't checked Mears or Jay's, but you can see this. They're under tremendous pressure to address these issues. And people say, well, you can walk and chew gum at the same time. But there's a question of whether they have the instruments to do that. They're regulatory instruments, but they're very second order in most countries. The central bank's not the only one. And the interest rate is a very blunt instrument. We're certainly, it's possible with these inflation, having experienced inflation and these different times, it will change. I cannot overstate these pressures that I just mentioned on central bank independence. So let me give you, give you a couple of data points on this. First of all, a friend of mine retired recently from being the head of research at a regional Fed, I won't name it, wasn't on the East Coast, and said, I was the last one working on monetary policy in my department. We have 9 or 10 people. They work on all these other issues, inequality, the environment, the weather, but they're not working on monetary policy. And I'm sure that's changed, but I don't know. Certainly the other data point I would put is the American Economic Association does a survey every 10 years with pretty similar questions. And okay, I don't always trust surveys, but since this one says something that I want to say, I'm going to cite it. They polled 500 or 600 people at the AEA convention every year. And there were a few questions, but I'll just pick on one. In 2000, they asked, who should take the lead in short-term stabilization policy, the Federal Reserve or fiscal policy? And in 2000, it was like 75-25 monetary policy. I don't know where the 25 came from, but they had that. And then it flipped in 2020, which is really hard to get your head wrapped around when you think about how political fiscal policy. I mean, look at what's going on in the U.S. right now. I mean, the idea that they're going to be able to perform surgery on the macroeconomies, scary. There are lots of things fiscal policy should do, and there's a big shock. It's different. I have to mention one other question, which I just have time for, that they asked was, should the main goal of the central bank be stabilizing inflation or and then they list jobs, jobs, which actually isn't the mandate, but a whole bunch of other things. And so in 2000, we'd still had the inflation. Inflation was the answer. Again, it was about 75-25, and it had completely flipped that, well, don't worry about inflation, by 2020. So I think that was before we'd hit this turning point, and maybe it'll be different going forward. Anyway, thank you.
Thank you, Ken. That was absolutely terrific, as we expected. So we've not been disappointed. There's been no turning point on that, at least. And as we've seen today, there are some ways in which central banks are asked to do much more than just monetary policy. Let me maybe open it up to the panelists and see if anyone wants to react to the points that have been raised by others before we then take questions from the floor. So anyone wants to, Gita, please.
Amir, if I may, you briefly mentioned about the use of FX intervention, and I said in my speaking points that it's a pretty tricky thing to tell apart when to intervene and when not to. It'd be great to hear from you how you think about that.
I think one lesson that we learned through economic history is that when financial crises intermingle with real crisis or other events, you can think of COVID as a health crisis, went into an economic crisis, and through a lot of the work of the Fed, we sort of averted a financial crisis. But we know those are the deepest, those have a magnifying effect when the two interact. And that's why when this event had started, it was, and we could already see there was a lot of things going on in Asia and other places regarding the shekel. That was the logic. You want to ensure stability. You want to make sure the markets function. You don't target a particular exchange rate, but you want to moderate things such that the markets function. There is liquidity. And that was our goal. And I think, as of now, as I showed you, the exchange rate sort of through events, obviously it's related to the events that are actually happening in Israel as well, but it gave it time. It didn't drift into panic mode. And that was the role of, and still is the role of FX intervention. When you have risk premia go up, that's the number one concern. There are people, when it happened, immediately say you should lower interest rates, help the economy. No, the two go hand in hand together. The idea was to stabilize the exchange rate. The exchange rate stability had periphery effects on the bond market and the stock market in Israel. They continue all to function. We came with the other prong approach with the targeted things for the households. And that was the way we sort of aimed at it.
So if I can, and in the meantime, if you are planning to ask a question, I will ask you to go and put yourself behind one of the mics so we can directly move to the questions afterwards. But before we turn to that, let me actually follow up with one question for, Amir and Jay. Jay, there's this incredible resilience in the U.S. economy that Gita mentioned. We've had this decline in inflation, and the economy seems to be powering ahead. Growth is really at a very high level. Consumption is very, very strong. There's this question about whether transmission of monetary policy is different this time around. Now, in your remarks, you've alluded to the fact that the sequence of shocks we've had is quite different from the typical business cycle, and so I was curious, and I would like to ask the same question to Amir, because in the context of the tightening of policy that you have done in the Bank of Israel, and maybe some of these resilience that Ken was talking about, building a stronger monetary policy framework, building reserves, etc., whether there is a sense in which the tightening operates in slightly different ways, there are longer delays, shorter delays. How do you view this from your own vantage point?
He's asking Powell here. Oh, right.
I would say a couple things.
Here he is.
Clearly, the U.S. economy has been stronger than expected. It's been more resilient, and this year is just remarkable, really. So many forecasters had a recession this year, and it's nothing like that. It's going to be close to 2.5% growth this year. But that's probably, in my thinking, probably significantly a function of strong demand. I think monetary policy is generally working in the ways that we think it should work, which is interest-sensitive spending, asset prices, exchange rate. I think there are some aspects of the U.S. economy where you can argue that it's a little different, and that would be, for example, households who are in low-rate mortgages are not selling their homes, but they're also not feeling the effects of higher rates because they really don't want to get out of those mortgages. Same thing with companies. Any company that had access to fixed rate borrowing and didn't use that in the last 3 or 4 years would be facing, but there are very few companies that are in that. So it may be that the U.S. economy is structurally a little bit more resilient to interest rates, but I don't think that I don't see at this point anything that seems to be structurally or materially in the nature of a difference.
Amir.
I sort of agree with Jay. I think the famous long lead, lags, it may be a bit longer. Partly people came out of COVID with a lot of savings. So the potency and the effect of monetary policy took longer, the adjustments of both supply and demand. But I think at least Israel also had, as I shown, a very strong recovery, and we are still above trend, but we're slowing down. So the effect of monetary policy was kicking in before this whole event. Inflation was probably on its way to our target in Q1 24. It just took, in my opinion, a little bit longer for these adjustments to happen. I also agree with Jay in his speech that the issue of supply, to look through supply, was there's a time to do that, but once inflation gets too high and too long, the expectation channel is so important. And as long as that was anchored in monetary policy, ultimately would kick in. It did take a little bit longer.
Okay, Jay.
I just want to, for a second, go back to something that Ken talked about, which is central bank independence. Unsurprisingly, I'm a believer in central bank independence. But it really is just an institutional arrangement that exists because the elected government allows it to exist. And as long as it serves the public well, it's a fine institutional arrangement. And I think it's easy to forget that we have this precious independence. It should be very, very rare in a functioning democracy that you have an institution that has the degree of independence that we have. Of course, we strive all the time to be democratically accountable and transparent. But I think that the temptation to wander into exciting new issues that really are the business of the elected government is a strong one and is to be resisted. And because I think that's when I think of ways that independence could be undermined. To me, that's right at the top of the list.
Very good. Any other reactions or comments?
Well, I would just add to what Jay just said. I mean, I think many economists, particularly over the last 15 or 20 years, just take it for granted, and they have these very sterile technocratic models and don't realize that central bank independence is something central bankers have to fight for every day. I mean, it's a very political environment with which they have to protect their right to do monetary policy independently.
Very good. So let me open it up to the floor. So I'm going to start with Martin here. Please state your name and your affiliation, and then I'll move back and we'll alternate. So Martin,
I think this might move
Martin
it.
Stürmer with the research department here at the IMF. Governor Yaron, thank you so much for joining us during these terrible times. I hope that you can live in peace very soon. Now, what are the scenarios that you are preparing for? What the kind of the worst case scenarios that you're thinking about?
The projections that we gave, as I mentioned, were contained to a situation where most of the war is really at the southern border. It takes until the end of 2023. It doesn't mean there's no interactions in the war in the north, but there isn't a full-fledged transition into a war there. That's a different ball game. It will have a different impact. There's enough uncertainties even around just the issues of the southern border, just dealing with the southern border, how how comfortable people will be coming back to some of the activities around there. The north border will be, if that happens, and we all hope that doesn't happen, this could have a much bigger implication. Is just a different scenario altogether.
Thank you. I'm going to go to the back, the lady over there. It should be working.
Hi, I'm Vivian. I'm an economist here at the IMF. My question would be to Mr. Powell. I wanted to hear your thoughts on that subject that Gita touched upon, which is the recent movements in the yield curve in these last many weeks. And I wanted to know if you think it's a change in natural rates, so maybe Fed funds rate should be a bit higher, or this is just a steeper yield curve, like higher term premium, so maybe Fed funds rates could be lower. And also, I would like to, I'm a bit worried about over-tightening on a personal level, of course. So what would be clear evidence for you that rates are in restrictive territory enough, given the lags? I mean, we could be over-tightening. That's it.
Thank you. So on your first question, on the implications of higher rates, it's when we move the federal funds rate around, the real point is to affect broader financial conditions, and broader financial conditions then affect the economy, the real economy, in ways that we broadly understand. But so we don't target any one financial condition. We look at broader financial conditions. So it's very hard to draw a direct line from one particular thing like higher bond yields to what monetary policy should do. So the first thing you would look at, though, is you'd look for persistent changes. Even then, and so then the question is, and Gita touched on this appropriately, which is why are longer run rates going up? And it really, the reason they're going up really matters, so we have to factor that in. So it's something we're looking at. We're certainly not going to ignore a significant tightening in financial conditions through that channel, but we don't have to decide. We're moving carefully now. We've moved very fast, and rates are now restrictive, and so we're going to be looking at this question, and not something we're trying to make a decision on right now. In terms of, I take your question to be, why are long rates higher? I think there are many candidate explanations, and 5 or 6 of them, it's easy to get to a half dozen explanations. I think we really don't know. I think one thing to point out, though, is people are experiencing these higher rates are actually affecting people's mortgages. The costs of all their floating rate debt is being affected. So it's having an effect on the economy. You know that the standard thinking has been that this was largely about term premium. Then the question is, why term premium? I don't want to try to dive into all of that today, but it's something we're looking at carefully and just seeing. In terms of you mentioned over tightening, but how are we thinking? So I would just go back at the beginning. Really, the question was to move as fast as we could. As I went through with the chronology, in early 2022, it became obvious that we needed to tighten policy as quickly as we could, and also at a reasonable pace. So we did, and that was the main thing, was speed. The second question was going to be how high to go, and we're still on that question. We're still on the question of a policy stance that's sufficiently restrictive to bring inflation down to 2% over time. The next question will be how long to keep rates restrictive. And so we're looking at, there is no magic to it. We're looking at the incoming data, of course, but really we're looking at the implications for the outlook. It's really what are we learning about the outlook, the balance of risks, and all those things. And we're trying to make a judgment at this point whether we need to do more. And as I said, we did move very quickly. The speed is no longer, the main thing. The main thing now is to try to get to that right level. Of course, we don't want to go too far, but at the same time, we know the biggest mistake we could make would be to fail to get inflation under control. So that's not going to happen. We will keep at this until we succeed. So moving carefully and looking at all the evidence and trying to make smart decisions on behalf of the public.
Let's go in the front here, sir.
Thank you. I'm Charlie Kimball with the Korea Center for International Finance. Both in the United States and presumably in Israel, in 2020, fiscal policy and monetary policy were in line. And now they seem to be at cross purposes. That is, we have very easy fiscal policy here and presumably in Israel. Does that mean that the real rate of interest that you should aim for should be a little higher?
Amir,
do you want to go first?
I think this situation, I'm not sure we're in different situation right now in the US. So I think, the job of the government in this kind of an emergency war situation is to supply the needs of many of the people who've gotten hurt from the war, and to try to minimize as much the damage that might be from this event, and that require fiscal spending. There's also, obviously, as Ken mentioned, there's likely to be more military spending over time. And the point that I was alluding to was that we need to find the right balance where, on the one hand, these spending be done, and at the same time go and very carefully find less needed, or especially given the circumstances, items in the budget, and direct them into those spending avenues, such that the fiscal stand over time, and we've demonstrated very responsible fiscal position. And I believe that if we do that, while the debt to GDP of Israel will go up for a while, the fiscal position will retrieve back and fundamentally can avoid structurally changing. But that require to do these appropriate adjustments over time that I mentioned.
So first, the thing to say is that we stay very far away from commenting on fiscal policy, even indirectly. So I won't do that. But I will say the way I'm thinking about this is let's look at where real rates are. So the federal funds rate's at 5.3 and change. If you take a 1 year forward look at inflation, maybe that's 3. So you've got real rates that are above 2%, and that's well above most mainstream estimates of where the neutral rate might be. I think that our star is as a not a particularly useful way to think about policy, because it can be affected by so many things and it changes over the short run and the long run. So I think I tend to look at it that we're in the range, we're in the place where we have restrictive policy, and probably significantly restrictive policy, and we're watching the effect carefully on the economy. I think the question of, has the neutral rate risen or will it rise, and will that be because of this factor or that factor, is less interesting given the policy job that we have to do. Of course, we have all the models and we look at them and things like that, but really I think about it in a more practical way.
Final question, sir.
Dr. Mamadouba from Harvard University and Atlantic International University in Hawaii. Actually, the biggest problem in the world economy is inflation. Why the Fed did not change its fundamental goal from unemployment to inflation? if you understand.
I'm sorry, could you repeat that?
What?
Yes, actually, the fundamental goal, the biggest problem in the world economy is inflation. Why the Fed, your bank did not change its fundamental goal from unemployment to inflation like the ECB?
Great, thank you. So we have a congressionally set mandate of maximum employment and price stability, and those two goals are equal under the law, and we can't change them. Only Congress can do that. We do have a provision. The question is, what if we're very far from one of those goals and not so far from the other? And what we do is when we say this in our constitutional document that we've written, it's not a matter of law, but our policy would be to focus on the one where we're farther away from the actual goal. So 2% inflation, we were a year or so ago very far from 2% inflation, and that has been our focus. As inflation comes back down, it becomes more of an equal weighting thing. And when you're equally far away from each goal, then the two are equal because they are exactly equal under the law.
Thank you. So I want to thank our panelists, but I would like to give a chance to Ken to maybe have a final word, since this is this whole thing is for you. So
I think people were pretty interested in hearing everybody else on this particular panel. I will say on this last question about fiscal dominance, it's a very different thing when you're at war and fiscal spending's taking up, I don't know the number, but half of GDP suddenly. Defense spending's taking up half of GDP suddenly, and there's no country which looks at its inflation targeting framework exactly there. Nobody does that. I don't think anyone fully did that even in the pandemic. You don't have to comment, but I mean that had a certain war-like feel at the beginning. It's a very different situation where you really need to reach into the toolkit because the national objectives are now, very different than just unemployment and inflation.
So please join me and let's thank all our panelists today.
Okay, guys, that is it for today's show. Again, let me know what you guys think. Some of y'all in the comments are making me laugh right now. But yeah, again, if you haven't already, check out our sponsors. I appreciate the love. Thank you so much for helping me hit 118,000 subs. We did break 118,000 subs right now. And so I appreciate the love so much. Tomorrow, be tuned in bright and early. Next week, we got CPI. We're going to cover all this stuff. We cover all major economic reports, earnings, CPI, Jerome Powell, press conferences, FOMC meetings, everything you might want to know. If you don't want to miss anything in the market, just subscribe, hit the notification bell. We got you covered here. So subscribe if you appreciate the love from the channel. Hit the like button. We appreciate it. Also, check out our sponsors. First sponsor is called Chart Prime. It's a trading view indicator service that you can use in stocks, crypto, Forex, futures. Ones that I've been really playing around today. There's two major ones that I've been kind of messing with. The first one is the Market Oracle Pro on a 1 minute. This thing is actually surprisingly accurate. I was always kind of against software, but this actually kind of turned the corner for me and showed me that software can be really accurate. Look, let's back test it. I know I back tested it earlier today, but look, let's just back test it from. Let's back test it when the market's the most volatile, which is here, right? So look, let's back test this and zoom in really quick just to show you guys how accurate this stuff can be. Okay, so look, so this is the Market Oracle Pro. Buy, bounce, sell, drop, buy, bounce, sell, drop, buy, bounce, sell, buy, sell, buy. This one maybe you could say was wrong. Strong, we moved up a little bit. This one you could maybe say was wrong. But that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So again, 2 out of 14 were wrong that I can see here. And maybe, again, I can't guarantee you're going to make money from this. Nobody can. But that looks pretty powerful to me. There's so much other stuff too. If you put a 5-minute chart up, and you can use it on any time frame, stocks, crypto, Forex, futures, again, if I put the regular market Oracle up, like just the regular market Oracle, there's like reversal signals. I can put up chart patterns. There's just so much stuff. Here's a regular 5-minute chart too. And you can kind of see they called this big drop. Look at the strong sell signal here. And then this is literal hours of dips, literal hours of dips. And so there's so much stuff that they offer. It's called Chart Prime. It's a trading view indicator service. Again, I challenge you to backtest it yourself. I'll put the link up if you want to check it out. I also put the banner up here. My other sponsor is called Top Step. Again, I'm going to put the Chart Prime link up. My other sponsor is called Top Step. It's a funded account program in futures. And so if you're one of those traders that want to day trade, there's no PDT in futures. You can day trade short, all that good stuff in futures. And there's no PDT rule. You can day trade essentially the SPY and what's called the E-mini. So like here's the SPY, here's the Q. I can day trade the Q as well. Look, if I put up the NQ, that's the futures contract for the Q. And you can day trade this, short this, buy market, all that good stuff. No PDT rule in futures. You can see it's the same price action if you zoom in here. This bottom and top one is the same thing. And you can day trade in futures, no PDT rule. And Top Step is the most legit funded program in the world. They give you a demo. The base one's $49. If you can hit their profit target on the demo without hitting the max loss, they fund you $50K up to $150K with a 90% split. And they pay out millions every year, fund thousands of traders a year. A great way to help support the channel is by checking them out. Again, I'm going to post this link here really quick as well. Great way to learn day trading. Most day traders lose money, and I'm definitely biased in their favor because they pay me money, of course, and they're a sponsor of mine. But it's incredibly useful to limit risk. I lost thousands when I first got started trading. This is one of the ways where it's like most day traders lose, and I think that's true with these as well. But if you lose, you're only out $49. It teaches you how to trade under pressure with less risk is what it does. And if you're good enough to pass it, you still keep 90%. So again, check them out. Here's the link. Great way to help support your boy here in this channel. We're going to move over to our crypto stream right now. It's going to be a quick show, but we are going to move over to our crypto stream. It's going to have to be a quick crypto stream. Let me make sure the redirect is working. And again, we're going to move over to the crypto show. We're going to be covering a lot of stuff here today. So again, don't go anywhere. If for whatever reason it doesn't redirect you, which I think it should, but if for whatever reason it does not redirect you, I'll give you the link so you can check it out too. Yeah, again, don't go anywhere, guys. Listen, as soon as we close this down, it's going to bring you to the crypto show. Here's the crypto link. I'm going to put that link up in chat. We're going to be talking about a lot of the latest crypto news in the market as well. And so again, here is that link right here in chat. Y'all be good. And yeah, see you guys over there. All right, guys, let's give redirect some time to work really quick. I don't think I ended my stream yet.